Mira said, I represent Miami Angels. I'm one of a two-person super big team. What we're doing in South Florida, and actually the state at large, is investing in software technology companies. I'll get more into that, but just some context as to who's the guy talking. But by a show of hands, would love to get a sense and a pulse of who's in the audience. Let's start with founders. Okay, so about a third of the room, half of the room. What about industry professionals? Okay. What about other investors? Okay. Okay, so pretty diverse group. Anyone affiliated with the university? Okay. Okay, great. Awesome. So looks like we're going to have a little bit of everyone here, which is really great. Allows us to view this from a different lens. I'll also aim to make this as interactive as possible. Like I said, since you'll be receiving this, you'll be able to review a lot of it. And so just general run of flow, just so you guys have an idea. I'll run through the deck. There'll be a point where after the deck, if anyone feels up to the task of pitching after what we saw, would love to invite you up here, give you feedback. And then after that, assuming there's someone brave enough to do that, we'll jump into the Q&A, okay? So, and then we should get you guys out of here by 3. So if that's a solid plan, then let's go into it. So again, the art of the pitch, and I'll spend just a few seconds here on the first slide because the pitch is truly an art. There's no formula, there's no silver bullet to giving your pitch. It's very much a stylistic thing, but at the same time, it's also knowing some of the really critical pieces of information that are communicating the idea of what your business is and does. Form meets function. Form meets function is usually what we mean when we say the art of the pitch. So again, diving a little deeper into Miami Angels, we are a angel network collective, angel investor collective, which basically means that software technology companies come to us at the earliest stages of their financing. Typically, our group invests in companies somewhere between $25,000 to $75,000 in monthly revenue. If it's a SaaS-based model, that's monthly recurring revenue, and if not, it's just monthly revenue. However, we do invest pre-revenue when a company isn't making money, and also out of that range, so after $75,000 in monthly revenue, monthly recurring revenue. On top of that, our membership is 110, 120 members strong. All of those investors who are part of our group are accredited investors who, a lot of them actually do this full time and invest in companies and leverage their prior experience helping the companies that they invest in, which will actually bring us to a later topic that we'll talk about called smart capital, which is basically investors who are there not only to provide you with money, but also resources, their time, and all the benefits of that. So our approach, how we view investing. First and foremost, we always look at the team. Is the team that we are investing in as a group one who's going to be able to execute on the vision that they are selling, or in the case where you have to pivot because maybe the business that you get invested in has to change direction or has to change strategy, right? Is the team that is leading the charge in that pivot going to be able to execute? And so with all the different things that can happen with a business, we need to be absolutely sure that the team can execute and do so flawlessly. So it's really a bet on people more than a company. Next, product. And this is with the exception of the team, this is in no particular order. We view product, market, and timing pretty much the same, but team and people is definitely at the top. Product. Are you creating unique and innovative tech solutions that are solving real-world problems? That one's kind of self-explanatory. Market, big markets, right? is your product going to revolutionize the market that you're in? And if so, those are the bets that we want to make, right? Especially at these early stages.
Can I ask you a quick question?
Sure.
What do you mean by a big market? Is it like $1 billion, $100 billion? What's a big market?
Yeah, I mean, to peg it at one thing is it's slightly arbitrary, but I get the nuance of the question, and it's, you know, it obviously depends on the investor and their appetite. You know, you have some investors who may not be in the business of investing in, you know, the next Ubers, and they're just fine with you know, with a multi-million-dollar exit and maybe not the billion-dollar exit. I think it's really dependent on the investor. Speaking about our group in particular, we're all looking for, you know, the next company, the next Uber, the next whatever that is. And I think it's, you know, if we think about the early stages of companies, and the overall reason why we were formed, we want that big explosive company to exit at this multi-billion-dollar valuation in Florida, because we don't have those today. We don't have those like the New Yorks, the New York Cities, the San Franciscos of the world. So if our group can be a part of the next Uber, the next Airbnb, we would love for that to be here. And so that's why we're focusing on those really big, massive markets. Does that help? Awesome. Timing. So an entrepreneur, former entrepreneur who had one of these really massive exits, who's a part of our group, he gave a talk probably about a few months ago, and in it he said that apart from team, one of the most important things that he looks for is why now. So, you know, timing is not only are you fitting a massive need within the market, but is this what the market needs now, right? A classic example of this is MySpace versus Facebook, right? Some say MySpace was a little too early before its time, but then Facebook came around, really perfected the model. That's up for debate, but for all intents and purposes, they were the version 2.0 of MySpace, and then, you know, we see the success that they have today. Our model, just in general, and this is actually a really good representation of what any organization in venture capital is doing today. So what we do is we source, which means basically speaking to great companies and great founders, learning about their businesses, and understanding whether one, we can invest, and if not, can we help? So you'll find that a lot of the really great VC groups of the world and angel networks of the world, you know, really take this seriously, because at the end of the day, they're here to find and identify really great companies, and if they're not there at that stage now, how can they help create those relationships and foster the growth of that company? Screen. So screening is, we're getting a little, at least for our group, screening is the first step of our formal investment process at Miami Angels. So that means jumping on a virtual conference where selected members of our angel group are evaluating companies. We do a 10-minute pitch and a 5-minute question and answer. And within that 15-minute slot, our angels are to the point where they're able to understand the really good companies from the not so good, at least at that point in time. So that really is, like I said, our first soiree into the investment process, at least formally speaking. Then, of the 5 to 7 companies, let's say on a given period, we see go through screening, about half of those go to pitch. Pitch is a larger event where we have almost half of our membership come and see companies pitch. That's 15 minutes of a pitch and then 15-minute Q&A. And then on the fringes of that, we have really great conversations between founders and investors. And all of that goes to eventually the next stage, which is diligence. And this is probably the most involved of all the stages, because it really is going under the hood of the particular company, diving into financials, diving into how the business operates, and basically understanding whether it's viable. Next one is invest, which is obviously where we hope all companies get to, but in reality, through all these different levels, we have about, I'd say about 2 to 3% of companies from the top of the funnel go to investment, and that's generally what you see in the industry. 2 to 3% making it from the top to the bottom.
Sorry, quick question.
Yeah.
The diligence, roughly, I would imagine it depends on the company, but how long is that period?
Great question. So diligence, I'll paint really broad strokes, but it can be somewhere between 2 to 4 months. We sometimes do it quicker. I've had diligences done in a couple weeks, but it really just does depend on resources. In the scenario of a VC diligence, you have actually partners within the firm assigned to a deal, and if they're between others, it sometimes gets elongated. So, yeah.
Mohalis Pabra. This was in the prior slide with the 4 sections, the 4 areas you're looking at. Out of the 4, I would think timing is the most difficult. At least that's the one that's hard to either predict or control. Bill Gross said the same thing, that timing is the #1 factor in the success. So what recommendation you give to do that? Because a lot of companies like Uber's, Airbnb, Facebook, when they think about timing when they were building it, it's just the timing was right. So what recommendation?
I think it goes back to like if we go back to the first slide, the art of the pitch. I think it's all messaging. I think it's convincing the person that you're pitching to that now's the right time, and then hopefully you break through to that. But it definitely is a messaging aspect, and I think a lot of that is on the onus of the entrepreneur. But great question. Yeah. So what we're going to get down to today, the startup funding cycle, getting in front of investors, the pitch deck, and effective pitching. So why is it that you're raising funds? And this is such an important point because as an investor, as a person that invests represents a group of investors, I can clearly say that confidently say that not every company needs venture investment. As a matter of fact, I was having a conversation. Where are you? With my friend over here, and there are just some companies that just don't need venture investment. And there's a lot of reasons, and there's a lot of debate that goes into why VC or why bootstrapping, why other forms of financing like debt. So just go into this conversation that we're having, really just understanding that evaluate the choices that you have, because in some cases venture investing may not be what you need. And we can get into that later in the Q&A. Would actually be a really great conversation for us to have. So in general, this is the startup financing cycle. The valley of death, as we like to call it here, is this point in time where a ton of the companies that I see are in, and that is really proving out the model, finding product market fit with the business, and making sure that what it is that you're building is investable. And then what you hear about on the news is all of this really getting into this, right? The multi-billion-dollar SoftBank deals, what dominates the news recently, or for the last few years, is all of this. But in reality, we're over here, right? And this is frankly the most exciting part of my job, because I'm able to help really great entrepreneurs understand how to navigate this and eventually get up here. And actually really over here, right? Because that's where an IPO and an exit is really where entrepreneurs want to be. So this is to your point on timing. Like I said, don't raise until you need to. If you think it's going to take 3 months to raise, set aside a couple more months, right? So as you enter the decision to raise a round through venture capital, or really debt, or other forms of fundraising, you're really going to want to make sure that you have the time, not only for the business and the resources that you have available to sustain that period, but also that you as a founder are going to be able to have the time to dedicate to that. I was having the same conversation before we started on a CEO's job before and during a fundraise is entirely different. Because a CEO's job before a fundraise is to really push the company forward, to help the team, and just continue moving the company forward. When you go into a raise, it's entirely different. It becomes conversation after conversation after conversation, sending deliverables for the diligence process, having a bunch of pitches. It just morphs. And so all that's to say, not only do you need resources from a company perspective to be able to weather that period, but you also need to be able to have that time set aside as a founder and make sure that your team, first and foremost, is solid and able to weather this as the funding occurs, or the fundraising process occurs. So as I was saying before, go for it. Sure.
Fundraising. You often see situations where let's say the offer or the construct of the financing changes over the period of time from the initial conversation of what the company is looking for at the start to what is subsequently invested. Because obviously, let's say you're bootstrapping it,
Yeah.
put more money in over that period of time, so you're more invested, and also your metrics can change, and I guess the risk factor from the investor's perspective change over, let's say, 5 to 6 months of a startup business.
Yeah.
Do you see that change in terms of the offering, or does it pretty much stay the same?
It stays the same. I mean, unless something's uncovered during due diligence, usually it's a pretty binary thing where they'll submit a term sheet that outlines their investment at the front end of the due diligence process. That'll essentially, even though a term sheet is non-binding, there's a full faith effort to honor that term sheet, and unless there's something really egregious found in due diligence, that basically stays as the framework. And when I say it's binary, usually things that are uncovered during due diligence, if it doesn't change the term sheet, it'll just destroy the deal. To your original question, I don't see any movement.
I was thinking more in a positive way.
Oh, in a positive way. Oh, yeah, rarely, because usually investors who are going to advance you to due diligence, their intuition usually sets the groundwork for the term sheet in the first place. But yes, we've seen that happen before. Great question. Sounds good? Awesome. So again, on the concept of smart capital, which I think is just so important, especially if you plan on raising in markets that maybe aren't as mature as like a New York and San Francisco. Miami and South Florida is a great example for that. Really look out for those groups that are not only going to be able to give you money, like I was saying before, but also resources. And one thing that we really pride ourselves on as a company is that all of our investors who go into companies offer whatever they can do to help a company, which is just so powerful. Because the job of a founder is sometimes very lonely, right? Because you have all this pressure, you have all of this responsibility, and when things go south, like they do in many journeys for startup companies, to have an investor who's invested not only in the business and in a financial way, but also on a personal, helpful way and able to facilitate productions is so huge. And in a lot of cases, helps companies weather those really bad and unfortunate times. So now you may ask, how do I get in front of these investors and those in particular who are of the smart capital class? Well, obviously, warm introductions are great, right? Hey, Dan, I saw you at the Skylab presentation that Miami had. Would love for you to send. Would love for you to check out my deck and give me your thoughts. Right? That's a great way to approach people, especially ones that you've heard talk before or seen or interacted with. It's a great way to get in front of them. LinkedIn outreach. This one obviously probably doesn't convert as well as warm introductions, but they do convert. And so I wouldn't say don't do LinkedIn introductions. As a matter of fact, one of our investors, as part of our group, was one of the original checks in Twitter. And he actually received that opportunity through a cold LinkedIn outreach. So, obviously the percentages are small, but I would still do whatever you can to get in front of investors who are really going to, change the trajectory of your company. And same thing, cold emails, would always try it. Obviously, craft your messages in ways that are going to engage a particular person. I wouldn't, I get this all the time, but I get blanket emails, hey, check this out, and a lot of those, unfortunately, get lost in some of the other more better crafted emails that I see on a daily basis. So the deck, and actually before I continue, like I said, this is all general. So morph it to your style, to your company, and whatever it is that you want to tweak, feel free to do so. This is a very personal product that you guys create. So typically, I see decks between 12 and 20 slides, and it doesn't have to be the prettiest thing in the world as long as it communicates a clear message. And that message really breaks down into these different buckets. Like I said, you're going to have more, you're going to have less, but these are generally what I see as the really effective pitch decks that come across my email every day. So best practices, follow up. Especially if that person writes you back. Like I said earlier in the presentation, I'm seeing probably 50, 60 companies a month, and I'm just not able to get to every email as timely as I would like. So when you reach out and follow up with investors who are looking at your deck, you're for the most part doing them a favor by reminding them. At least for me, you are. So follow up with them in a way that's respectful and really makes it easy for them to reply back and get to what you're asking them to do. What you should not do. Like it says here, don't get too fancy. A PDF deck works. That's actually one of the biggest things that I think is helpful. When you think about the idea of a venture capitalist, their inbox is, never going to be inbox 0. It's the other end of that. It's inbox 100, 200, right? So if you send a link or to redirect them to an entire platform that needs them to create a username and a password, you're creating just a lot of friction between the investor and what you want them to see. So just be really simple. Send them a PDF. This is what you need to see. It makes it very, very simple, and you'd be surprised how many links I get, how many redirects to portals I get. So just really simple, works. So now we're going to dive into each individual section of a pitch deck, and I think the best way for us to do this is talking about a company that we probably all know about. So so here's what we'll do. I'll ask someone or a few people to tell me the company that they want to talk about as we go through the pitch deck deep dive, and we'll basically construct their pitch deck for that particular company. Sounds good?
Yeah.
Cool. So let me hear some companies. Airbnb. What else? Facebook, okay, that's one.
Lime.
Which one? Lime, okay, the scooter, okay. Snap, okay. Let's do, any preferences before we jump into one? I'm trying to find one that everyone would be familiar with and that we could jump in with. Let's say Airbnb, okay, awesome. Airbnb. So imagine Airbnb's cover slide, right? The first thing that they would do is put their really nice, simple logo at the top of it, right? And then Brian Chesky is going to be the name at the bottom of it, and and it'll be very simple, right? That's what a cover slide should be. You'll get all the details when this deck gets circulated, but we'll keep this really high level. Now the elevator pitch, right? What would someone say Airbnb's elevator pitch is for this particular slide? Don't all jump at once, huh?
Providing low cost, single night stays for the shared economy.
Exactly. Something to that effect. Something really simple that, in a nutshell, says what Airbnb is about, right? Market problem, current solutions. Let me get someone on this side of the room to let me know what's the market problem that Airbnb is trying to solve for.
Short-term rentals at your fingertips.
Okay, and now convenience, exactly. One could say price, because the alternative to an Airbnb is a hotel, right? At least before they really came on the scene. So this slide at its core is going to be about what's the value prop. Sorry, I'll get away from synonyms. What's the value proposition, right? What is Airbnb trying to disrupt that this market is already has a hold of? In Airbnb's case, it was hotels. Hotels, ubiquitous, we all see them. But Airbnb is trying to flip the paradigm, trying to tell people that the problem we're solving for is price, convenience, like what was said, and accessibility. So the market opportunity, like I said, hotels are ubiquitous, right? I mean, there's a hotel pretty much everywhere. And so what Airbnb was doing was tapping into a market that almost redefined the category, right? I mean, at least me, I never use hotels anymore. I use an Airbnb because it's just that much better of a solution. So addressing the market and what the potential of that market is for your particular company is huge. And what's really important about this slide that I get a lot of questions on is that people always ask me, I have no idea how big the market is, right? I don't know how to even start. And the fact of the matter is, no one does, right? Because no one really knows what the market opportunity is. So the key takeaway here is use your best judgment when trying to quantify a market for an investor. And you may say, but Daniel, what if I get called out on the market opportunity? And that happens often. I'm not going to lie. But what I would say is always source and explain your rationale behind the particular market size that you're pegging. Because at that point, no one can really say that's wrong. What they'll say is, let's have a conversation on how you got to those numbers. And if you source it and you're easily able to refer back to what came into that market opportunity calculation, then that really helps move the conversation forward and makes it less adversarial and more conversational. Really, it allows the investor to dig into your mind and what you're thinking about as the particular market. Now, I want to ask explicitly if there are any questions on this, because it is very important.
Something that's new or novel, and you don't feel like you can confidently come up with an actual number. Do you think it's okay to give sort of triangulated metrics, like, well, this is growing and that's growing?
Yeah, and that's one way, that's one method of valuation, or in this case, sizing a market. So yeah, absolutely. But what gets lost on some is just stating that and not really explaining the rationale. And then like I said, it becomes more of an exercise, at least in the investor's mind, of understanding how you got to that number. And if you're really upfront with that at the very beginning, it becomes more of an enriching conversation, an informative conversation, when it's about your thought process as opposed to the actual number on the page. So it's almost you're skipping the most contentious part of this slide by just saying, this is how I thought of it. Let's talk on that. Great question.
Just to confirm, every page they're showing is going to be one page.
Exactly. Yeah, every slide here is meant to describe a slide on your pitch deck. Great question. Yeah.
Sometimes one can argue for Airbnb, right? If you think about the market is huge.
Yes.
If you're a new company and you go to an investor, of course the potential is there, but also it's always a struggle to, do you go with your minimum market and you say, okay, do I go this and I can achieve this for sure? But that maybe will show that I'm being too conservative for the investor, or I go more bullish and say, wow, I can achieve a lot. So it's always, I struggle with that.
Great point. And This is actually, what you mentioned is sometimes what founders sometimes, a very tough situation that they find themselves in, right? Because you don't want to seem as if you're really overstating the market that you're trying to penetrate. But at the same time, you don't want to be very conservative. We've had deals go south for both reasons. But the common link between both of those, even though one was conservative and one was just really overblown, was the fact that they stuck by their numbers. They had no real reason as to why those were the numbers. And so that's why I say if you're confident and transparent at the forefront of the conversation, explaining to them how you came up with that number, it just helps equalize. And I find that those are honestly the ones that go much further. But as you're making these calculations, which is I think the root of your question, you obviously want to capture as much as you can about the market potential. And to your point, Airbnb in the early days versus Airbnb now is a whole different company, a whole different vision, a whole different way of executing. And so, yeah, I mean, I would say that Airbnb at the beginning probably undervalued what they thought was their true market. But no one's going to know, no one's going to know the difference between the market of Airbnb at the beginning and the market of Airbnb now, because it's hindsight, So just so the overall thing I would say is, yeah, just compile as much information you can, make a really educated and thoughtful argument for why you think that's the market. Obviously erring on the side of a big market potential. And if you could substantiate that, then that's great. I hope that answers it. Yeah. Yeah.
How important do you feel it is to really define what type of investor you want to work with or the type of people you want around you? Because I could imagine that if you do have a certain way of thinking, you want to be more conservative and rather overperform if you have somebody who, goes against that grain or they think differently. You find that a lot of founders have issues with those types of investors later down the line because sometimes, time is precious, and if I'm wearing a lot of different hats, I don't have time to pick up the phone every single week and have an hour-long call on what we're doing versus the people who are just cool, do your thing, let's talk once a quarter or once a year.
Totally. So there's obviously a happy medium between investor involvement. Say again?
Question.
Oh, yeah. So the question was, along the spectrum, what type of investor do you want? Do you want one that's super involved, hey, Steve, the person who asked the question, what are you doing here? What are you doing there? When are you going to report to me this, that? And then on the other side of the spectrum, one who just says, hey, let me know what you need from me. We'll check in every quarter or so. What we find, especially in software technology companies, is that there's no one who knows the company better in terms of product, in terms of operations, in terms of execution, than the actual founder, right? So in situations where you have investors who are more prescriptive and sometimes forcing your hand, it's most of that, I can't say all the time, but most of the time usually doesn't work out for the benefit of the founder. So find that founder who's able to, provide you money first, provide you smart and thoughtful help and interactions and facilitate introductions, and more or less take the back seat, right? And allow you to do your job really well, and also allow the founder to know, if anything, if stuff hits the fan, I have this investor who I can confidently say is going to help me in any way that he can. So great question. Was that good?
Yeah.
Awesome. So your solution demo. This is really, really, really important, just like the last slide was. I can't tell you how many decks I get that describe a product, describe a company, and after I read it, I have no idea what's going on. I have no idea what the company does. I have no idea what the product is. And in those cases, I just ask them, can you just send me a screenshot of your product, of really critical screens that a client would see that define your product. And in some cases, a screenshot isn't enough, right? Sometimes we have to actually do a demo, a 10, 15-minute demo where I'm just walk through the different screens. I understand the workflow. So What I find, the two most common ways to really communicate this well is sometimes many screenshots of different slides, or just a simple like 1-minute video, right, that describes the product, the company, and whatever else you want to communicate in that time frame. But it's super important to show that, and not just let words on a page speak for themselves. So this is also a very important slide: traction, performance, and awards. Awards, I would say, is minor because some folks are really out there grinding, putting their head down, and focusing and executing on the business. But if you have awards, that's great. I would definitely showcase them. Now, the two most important ones is traction and performance. Over time, what's been growth, right? I can tell you what we look for is somewhere between 30 to 40% month-over-month growth. And that's what really any VC will look for, especially at the early stages before Series A. So in addition to growth, right? How many clients are you acquiring? How are they churning? Actually, before I continue this, there's a lot of terminology here that some people may not know. If I say anything that is unclear or that you'd want me to elaborate on, feel free to interrupt. But as I was saying, churn. Once a client comes in, how quick is it before they leave? In addition to that, what's revenue, right? What's been revenue not only over the year, but month over month? And so there's a variety of metrics that indicate traction. And so really identifying those and putting them on a slide and in a way that describes the narrative really well of your business and how it's growing is crucial. Another way I would define traction is, what do you define as your core metrics to the business? I tell every founder, because I had to do this myself when I was an operator, there are at least 3 really core KPIs that you look at on a daily basis for your business, and my business is healthy, my business is growing, my business is good in my eyes. So identifying what those KPIs are and sharing them on this particular slide is going to be really, really important to not only explain to the investor, this is what I'm looking at, these are my core metrics, but also allow you to have a conversation on the deeper meaning of those numbers and why they are what they are. The revenue model, really great. How do you make money, right? How does a company, and yours in particular, make money? That's crucial for an investor to understand right off the bat. We've all heard some models like freemium models, which is a type of a revenue model. If you have a freemium model, I would definitely explain that. I would also explain for freemium models how, if what you're delivering to clients and users is free, what other revenue streams are you tapping into to help keep the business going? And obviously, if you have a more traditional business model where you're making money for use of the product, et cetera, obviously explaining that here. So more traditionally called a go-to-market model or go-to-market strategy is explaining to your investor what are the costs associated with entering the market that I'm entering. And so common metrics in this particular slide are things like cost of acquisition, otherwise known as CAC, LTV, lifetime value. So the common pairing between CAC and LTV is it costs me X amount to acquire one customer, and that same customer gives me this amount of money over the entire life of them as a customer from my company. Anything on this? Lifetime value. Lifetime value.
Lending side.
Yeah, loan to value. Yeah. Great point.
For the cost to acquire a customer,
Yeah.
is that specifically broken down in metrics to get them, or is it all of your costs set against your total number of clients and having an all-in?
Great question. So what you're talking about, it's a great question. It's what's called blended CAC versus like a more specific CAC, and that's really when you get to the easiest way for me to explain it is understand. I would just put both numbers actually. Put your blended CAC and whatever specific CAC you'd like to place. But that way, whatever CAC it is that you put there, again, it becomes more a conversation of how you're thinking about those numbers than it is arguing on a particular position.
What's the reasonable assumption for maybe customers? Because a lot of startups haven't existed long enough for their customers to have market.
Exactly. And so that's a great question. One that we have. We talk about often because, like you very well put, lifetime value is constantly increasing because there's some I got you, Steve. There's some companies that haven't had churn, haven't had customers terminate their use of a particular product, and so in those cases, you find the value of that particular customer increasing. So in those cases, we actually had one company that we saw who hadn't had a single person churn out of their product and continue using since the time they started. And there, they just simply qualify that number to say, this is a lifetime value currently because we haven't had customer churn. And again, I realize we're getting somewhat technical. So again, if there's things that I can help clarify, please do let me know, Steve.
Quick question. I'm not sure if this is ahead, but we talked about like the revenue model, like having traction versus not. Now, if you have a revenue model and let's just say you have traction, but you haven't actually like executed on the service, right? Because it's like some type of solution where it would involve some type of investment. You basically need capital to be able to invest in the technology. You need to service the client. So if you have, let's just say like, I have 100 people that have pre-ordered like us, if we can execute on this model at this price, like how different is your valuation or how different, how should you think about that? Should you try to just go ahead and invest and get a few clients, or should you maybe just think like, hey, I have 100 customers ready to go, this is what we need to do in order to get them on board?
So the question was, how when you have a company that's either pre-revenue with a waiting list of people who are waiting to actually see the product and use the product, how do you pitch that versus a company that maybe already has traction, a product that is already launched in the market and people are using it? Is that a good? Okay. So it's hard to say because in the news you hear about, for example, Jet. Jet.com, which was acquired by Walmart for $500 million, hadn't launched commercially when they were bought for $500 million. So it's you have these crazy anomalies like that. But I can say, speaking generally, you're going to have an easier time getting investors to buy into a vision and a company really when you have traction. So now you may be asking, so then how do I raise money? And typically what happens is when a company's at its very early stages, pre-revenue, the type of company you were describing that had a list of customers, or even not, right? Just an idea. What people typically do is what's called a friends and family round. And those are people who you've selected, like the name says, friends and family, who may not even know what you're building or even care about what you're building, but they're willing to invest in you as a person. And usually that's the chunk of money that you need to see your idea become a reality, have a product that's launchable, and have users using it. So we see that, I'd say 95% of the time, being used to get the first capital that they need. Again, that's called a friends and family round. And I'll talk. This will be referenced in the deck. But another very good instrument when you go to invest in the friends and family round is what's called a safe note. Y Combinator is a startup accelerator out in San Francisco. They're documents that are so widely used that they're free. You can find it on their website, but it's like the legal documents that someone would need to raise a friends and family round. And that we can talk about that in a whole different section, but just something to note. Yeah.
Yeah, I just wanted to go off the question that he answered. I would think with these signed up and say they're waiting for this product, if you could get, did they answer, for instance, how much you're going to pay for it, and that is that modeled in your revenue model in terms of they say they're going to pay $100 for this, and this is going to be the gross margin, or are some of them ready to put deposits down? Maybe you have a guarantee, and they gave you some money, but they're just waiting to show that it's not just people saying you have a friend that just signed up. It depends on the model.
Yeah, that's great input. I mean, anything you can do to help an investor understand what's the very next step for the business in terms of traction is really helpful. So market fit and competition, and now when I refer to this particular slide, this is one where it's usually less forthcoming from investors, or they'll just say we're the best. So here, and actually throughout your entire pitch deck, I'm sure you've been able to understand that a recurring theme for me and a lot of other investors is to have just a transparent view into the business, and doing that through your deck is honestly the best honestly the best policy. And so when it comes to competition, really lay out who the competition is, right? And we'll go into some examples as to how you can display that information. But really do an honest assessment of what's out there and why you're better than them, why in some cases you're not better than them, and in the cases that you're not better than them, how through your product's development timeline or through your execution in the market are you going to be better than them, right? So this isn't a slide that you should just say, hey, I'm the best, or hey, I'm not the best, there's someone above me. Really dig into this idea of competition and the dynamics within the market, right? So here's an example, right? Your logo ideally should be here. But like I said before, qualify that with why you're here, right? And qualify why these folks are here. And again, we'll walk through a few different examples of how to display this. But before I continue, any questions on competition? Yeah. No. None of this is a given. This is, change this however you want. This is all just me giving you examples of how to potentially display the information. But by no means is this a given.
I'm specifically talking about the logo, for instance, if it's actually expensive and high quality.
Yeah, everyone's going to change these axes, these dimensions. It could be speed of access, right? And this could be user base, right? You can change all of this stuff. Here's another example, a Venn diagram, using a bunch of different industry segments to get to the point where this is where your company is. This is my personal favorite. But it's because I was a former consultant and I like tables. So this one I really like because it shows not only different competitors, but also across features. Right, which if the whole purpose of a deck is to allow an investor to understand why your product is investable and ultimately going to be better than any other product that's out there, I find that this really does a really good job in communicating that. So this is my personal favorite, but again, very stylistic thing. Yeah, did I see a hand up here? Okay, no, awesome.
Getting to style,
yeah.
Throughout the deck.
Yeah.
Balance of information versus
yes.
visual.
Yes.
Because again, there's many ways of skinning a cat, and you hear a lot about few words, and therefore, once you present it, then you will elaborate.
Yeah.
So what's that sort of, in your point of view, the balance of what you may say, like you're saying now, instead of just having it written, or
Great question. So I find that sometimes the deck is almost a representation of the person themselves or the company, and so really I adapt my my read of a deck by knowing a little bit about the person first. So I won't, if a deck is wordy, it's wordy. If a deck is very condensed and concise, it's very condensed and concise. So I necessarily won't judge it just solely based on that. And so, what I will say is for the decks that are really concise and condensed, sometimes really important parts about the business are lost. And in those cases, I have to ask for more information. And so you can imagine in this 3 to 6 month process of investing or fundraising, for every investor who asks for more information from a very concise deck, it stretches out that process even further. Now that doesn't mean, make your deck a Bible, but it does mean strike that balance between what's really important to have in your deck versus not. And so I think it's just using your best judgment to understand, one, what are the important points that you need to communicate, and I think that's directly related to who it is you're pitching to. So, and that's actually a really great point. That's another thing. And I'm sure many entrepreneurs can identify with this. But you should not just have one deck and one deck only. If you know that an investor that you're pitching to really can't digest a huge amount of information, adapt your deck so that it fits with that particular investor. Sure, it takes more work, but at the same time, if you have one or very limited amount of shots, take the time on the front end to adapt what you're sending them to their style. Yeah.
If your company, though, is more focused on, the biggest point is personalization and customized product, features comparison may not be your best sell because
Totally right.
at the end of the day, you can have a lot of features that are quick and easy that the computer can do. What would be your suggestion for a company that's really trying to sell its team more than its features?
Yeah, and I'll unpack that a bit more and say creative companies, right? Like companies that are created because they're offering a creative offering to the market, and in those cases, they're really flashy decks that are showcasing some of your abilities as a company. Totally fits, but again, it all goes back to this is a style, right? This is as much you communicating the information that you need to, as it is your ability to stand behind that document and make sure that it fits with your overall brand. So great question.
So I guess I don't know if this kind of on the idea, but a lot of times you'll hear recommendation people not talk about your competitor as much versus spend that time selling yourself and your authentic self and what's unique about you versus kind of talk. Where do you draw the line between how much information you can talk about your competitor? Because if someone's selling me something and I have this little breakdown list and I'm about to sign with them, now I'm going to look at this list and I'm going to overanalyze it and I'm going to start researching every one of these other companies. And perhaps something looks better visually on theirs and I'll switch.
You'll find that at least in my case, and actually this is probably a lot of VC's case. If they see a competitor slide where you're identifying other competitors and how they are compared to you within the market, they're rarely, I'd say, are they going to go to the company that you've identified as a competitor, and then potentially invest in them. And the reason why that is because, at least with the software technologies that we deal with, these competitors, right? If we think of Airbnb, for example, in its earliest days, and Airbnb is here on your company, competitor A, B, C, D, E for Airbnb would be Hilton, Marriott, and all the other big hotel chains, right? So an investor looking at a deck for Airbnb in the early days isn't going to say, okay, well, because Airbnb put Hilton, Marriott, et cetera, on their sheet, I'm going to go invest in Hilton, Marriott, et cetera. So, and that's just because they're too large at the time. There's a bunch of other things. But so all that's to say, don't necessarily be gun shy from labeling your competitors, because if you're able to effectively communicate why you're better than them, then that's going to add even more evidence and more ammunition to your argument as to why I should be invested in, or why your company should be invested in. So you could almost take something that's viewed as negative by showing your competition, and in the narrative that you create, tell them, your strength compared to your competition, and how you're totally going to do away with them with the money that they're going to invest in you. Which brings us to a great point. Competitive advantages, right? So why is your company, why does it have a competitive advantage? It could be the product, it could be the people, it could be the team that you've built, a variety of things, right? But you're going to want to be very clear. Patents is another one. You're going to want to be very clear as to why your company has a competitive advantage and what those are, and how, when you go out to market and speaking just to investment, how with the investment of a particular investor, you're going to be able to really take hold of the competition and obviously beat them. But this one is a very important slide, and being very thoughtful about how you are comparatively better, and what competitive advantages you have. It's very important to be thoughtful about that and place that here. So, as we were talking about competitive advantages, any questions on this before we move on? Perfect. Financial projections and financials, current financials for those that have traction. Let's talk about the company that may not have traction financially and is on the way to launching and getting revenue for their business. Projections are one of those things, very much like market opportunity, like you and I were talking about, or like competitive advantages, like we were talking about before. Financial projections, if there's anything that you know or that an investor knows when seeing financial projections, the only thing he knows is that it'll likely be wrong. And so what that should be is a relief to everyone, knowing that what you're putting on the slide for financial projections is not necessarily something that is going to be set in stone. You're like, oh my God, what if I don't hit these numbers, et cetera, et cetera. Any smart and knowledgeable investor is going to know that what's on the page is wrong. But what they are going to know is by your thinking and how you describe your financial outlook over time, from the time you launch your product to 2 or 3 years into the future, what they are going to be able to understand is that's not real and the logic is faulty. Or they're going to say, okay, I can understand where this person is going and how they expect their business to grow over time. So the most important thing here is not to feel like every last dollar has to be accounted for in some future world, because for everything that we know, the business today is going to be very different from the business for the future. And the only way you're going to know that difference is when you're in the future, right? So the really important thing here, like I said throughout, be transparent, explain the logical flow and your reasoning behind the numbers, and qualify it if you have to, right? Put a source at the bottom of the slide to indicate why you're thinking that way. But be very, very, very thoughtful about this. Don't just go in Excel, drag a formula across, and expect an investor to buy that. So just being really thoughtful about projections is going to be really helpful.
So you visualize an actual
spreadsheet?
Not a spreadsheet, yeah, and some bullet points? Or?
Some folks do, and some folks don't. I've had slides that just as effectively communicate their projections to me when they're really nicely done and not in a table format. I'm not saying table formats are bad, again, it just goes back to identifying what are the key financial metrics that you're going to want to see change over time, and explaining to an investor over year 1, year 2, and year 3 how those numbers are going to move. and where they'll be in your mind. But again, the investor knows from the very beginning, from the minute they open your deck, they know there's going to be a financial projection slide there, and they know it's going to be wrong. But again, it's not about that. It's about explaining your thought process and explaining why you think your company's going to be there. And again, this is actually a great point. You also have to imagine that a pitch deck is just one aspect of a pitch, right? The other aspect is exactly what I'm doing now, which is adding color to what's on the screen. So to the point you mentioned, you can very well add what's not on the deck by your conversation with he or she as the investor. So something to remember as well. Don't just constrain yourself to what's on the page, but also know that when you have the ability to speak to him or her as the investor, you can fill in the gaps that may be there. So, you had a question?
Yeah, just talking about having the spreadsheet and having a formula carried across. I mean, I've gone through this exercise, and I think, realistically, for a startup business going out to, let's say, 3 years, you can say, right, I want to add this additional headcount, they're going to cost this associated costs. After you get past 3 years, it then does become an exercise of saying, well, I think that probably costs are going to increase, let's say 5% per quarter, 10% per quarter, especially if you think your break even is going to come between the 3 and 5 year period.
Exactly.
Right? So I just want to make sure that is in line with an expectation.
Totally, and that's why me particularly, I don't like to see financial projections over 3 years, because in years 4 and 5, you really get into like space, right? It's really hard to know where your business is going to be in 4 to 5 years, let alone 2 or 3, right? I mean, you can barely account for where you're going to be tomorrow as a founder, and I absolutely recognize that. But that's why I'm saying from the very beginning, investors know that what's on the page is likely going to be wrong. It's more so just understanding the thoughtfulness behind where you think it's going to be. No, good, okay. So that's that. Anything else? Cool. Here's an example of the table. Again, you'll see this there, so no need to digest the numbers over here. And again, again, find the metrics that for your financial projection slide make sense and display them here. But this is by no means the end all be all for what you should display.
For startups, what are the good ways to get some of these assumptions? Because I know a lot of times PE shops and all that doesn't feel to get weird assumptions like this. Like, I want to look at, how's Gap going to do in the next 10 years or whatever. I can take assumptions from other different brands similar to it. But in our space, right, we're not that large, we're not operating with that much consistency, and we're not publicly traded. So it's like, where's a good resource or a good place to get some of these growth assumptions?
So this is where the job description of a founder also includes private investigator and computer forensic scientist, because a lot of the things you have to scrape, and that's through individual conversations with other people in your industry. That's doing some really hardcore searching on the web, talking to your competitors. You bring a great point. Of course, you want your assumptions that form the foundation for your financial projections to be somewhat in line with what investors would expect. And the only way to really get those is by having these types of conversations. And like you said, public companies are the only ones who by law need to present the data that they have as a company. But every single startup, assuming they're not publicly traded, can keep that to themselves. But that's again where founders have this hidden talent of being private investigators and finding these types of assumptions throughout their competition.
It makes sense that sometimes even outsource this piece so that you can say, hey, there's a third party that has done this, these numbers aren't necessarily coming from me, this is what this company that's in this space that I hired says.
Great question. Yeah, and so what you find is some companies, right, with all the stuff that they have to do on top of being a private investigator, just can't do it, right? And so there are companies, there are startup consultancies that will help you create your pitch, right? That will help you find these assumptions. I have my own personal view on those types of groups. I will say by and large, at least the groups that I've seen, they're always the founders who will do the digging themselves and compile the data. That's not to say that there isn't value in those companies, but sometimes there's just so much to do that you need the extra help, and those people will give it to you. Now, what I will say, if you go to seek the help and the service of those types of consultancies, these startup consultancies, make sure they're good, and make sure what they're going to give you is worth the money that you're paying them, because it's going to cost. So, yeah, just all I can say is just really, really do your research, because it's going to be so critical when you put that forward. I saw a few hands. He was first, and then Juan Carlos, and then yeah.
Yeah, when it comes to financial projections and unit economics, what is your general view on like non-GAAP metrics, right? Like Groupon got in huge trouble for that, but now we have WeWork, just raised a lot of money for community adjusted EBITDA. Like, yeah,
that's too technical. The only thing I would say is just make sure what you're doing is above board. You'll hopefully have an accountant. Or someone that can really help you, that can really help inform these projections. Just make sure what you're doing is according to BAR. And those companies, they have these issues because they never really had their books in order until they had this public persona, and that's really when it gets blown out of proportion. Ideally, you have an accountant look at your books before you decide to go public. And so that's all I would say on that. Just make sure what you're doing from the very beginning is in order. Yes, well, yeah, and then Juan Carlos.
All right, the takeaway I'm getting is everything is case by case.
Yes.
The investor is looking more at the thought process, more on the direct number. But from your experience and talking from the point of the consultants, have you invested in companies that hired external consultants to reach those numbers directly from your experience in Miami?
Sure. But that's not to say that you as a founder can do it, right? And so all I want to say is, while there are quick fix solutions out there, don't make that the immediate reaction, right? Because no one's going to tell your story better than you.
Yeah. So that's my question.
Exactly. So know that it's out there. If you really need it, go for it. And you brought up a great point at the beginning about case by case, and I want to stress that even more than what I've already said. Really know who you're sending this pitch to, because no investor is the same. You're going to have an investor who you may approach who's going to say exactly the opposite things that I've been saying, and you're just going to have to adapt your presentation to that particular person. But the real root of what I'm trying to say there is know the person who you're pitching to. Study them, go on their website, understand their thesis. Talk to other people who you have to understand who that person is. And sure, that may be a lot of work for every person that you're talking to, but I can almost guarantee it's going to be much more effective. Much more effective. And again, you only need a couple of investors to invest, right? And so if at the very front end of this process, instead of taking a spray and pray approach and just sending your deck to 100 people on an Excel spreadsheet, if you really take the time to understand who it is you're pitching to, like I said, not only is the process going to convert faster and at a greater percentage, but it's also going to make a more genuine relationship with the investor that you're pitching, which at the end of the day, you all want an investor who's you're going to have a relationship and one that you can count on. That's how the Ubers become the Ubers and the Airbnbs become the Airbnbs, because they have investors who, through the storms that they go through as companies, especially in the early stages, they're right behind them, helping them with whatever they need. So just something to think about. Yes. Oh, Carlos, I'm sorry.
Two different topics. Can you walk back? The first topic is related to the key performance indicators and how some of them are presented. For example, active users and attrition.
Yeah.
If you want to really present something that is more on a net basis, or you prefer to understand well how users are growing and the reasons and the estimations for attrition, in a separate way. Because sometimes it's not clear what is that number on a net basis involved. I don't know what kind of reactions you get typically from investors about those key performance indicators that are like a mixed conversation.
Exactly.
That's the first topic.
Yeah.
And the second topic is on the on the way how those projections are supposed to be working with including the money that you're supposed to be asking for. And that connects with different scenarios. If you're getting 100% of that, or how are you putting those additional funds to work in which areas, and how is the impact of that into the numbers and the projection of the numbers, so you put different scenarios depending on how much money you are aiming to. You understand?
Yeah, absolutely. So let me unpack the first one. The first one was actually a conversation that we had earlier about our conversation was about CAC. So we know that again, CAC is cost of acquisition, and every company, in order to get users to use their product, has to pay in the form of marketing, in the form of giving their product away for free. You know, a variety of ways that companies get customers to use their product, and all of that boils up into what we call cost of acquisition. And that's just some context for those who are like, Daniel, what's CAC? Which is a very, very common thing. And so in those cases where you have one number trying to represent a larger story of the business, just very simply put the types of CAC in our case, or in your case, divide out the financial metrics. So if there's a net number, if there's a net sales, but there's a gross sales, right? Don't just put one on there, put both. And the larger takeaway from that, regardless of the metric that you choose to put on your deck, is again going back to a transparent narrative that explains to investors that one, you're not trying to hold anything back, and two, you're thoughtful enough to put that on the deck and explain it. And generally, it just makes the conversation go much better. Then you had earlier about showing how investment funds will affect the business and its growth, right? That one I think we actually have, yeah, right here. So I'll touch on this one. Yeah, I'll touch on this one as soon as we get to there. Team. So again, what investors, it's kind of counterintuitive, and you know we can debate forever why this is one of the last slides. But again, when investors are investing in people, you're going to want to make this slide really stand on its own. So when I say that, I mean explain all the relevant experience that all your team members have, and at the end of the day, the investor's going to want to know between the CEO and all the other members of the team why they are the right people to execute. If you feel after looking at your team slide after you've built it that putting yourself in the shoes of the investor, which is hard to do because you love your company, you love your people, but for the sake of this exercise, you're going to have to do it by removing as much bias as you can. You're going to want to say to the investor, and the investor's going to have to really understand that. Right, they're gonna have to look at the slide and say, that's the team that I'm gonna bet on to make this a reality. And not only make it a reality, but blow it out of the park. So between relevant experience, between prior exits, between a nice headshot, between whatever you can put on that slide to really show, the team that you've built and why they are so important to the success of this business, is honestly going to, in some cases, make or break an entire picture. So just as important as it is for me to invest in a company based on the team, it should be just as important for you to demonstrate that in your pitch deck.
As part of the team, do they have to be like full-time?
Great question. So let me put it to you this way. We've never invested in a company where the CEO has been part-time, where the founder or the founders have been part-time. And when I say the founders have been part-time, I mean really core founders who are affecting the day-to-day of the group. But again, that's from a VC perspective. If you're talking about friends and family, right? If you're raising money from friends and family, there are many cases where founders are part-time. They're not ready to pull the plug on their only source of revenue, right? They need to make sure that this thing works before they quit everything and go all for it. But as far as seed after friends and family, the seed round and every other round after that, you likely won't find investors who are willing to invest in part-time founders in those cases. Really good question. Board and advisors. So these are the folks who are helping your business grow behind the scenes. It's a group of people that you've assembled who aren't full-time on the business, but they're the types of people who are industry experts, who know you and your company very well, and are almost more part of the backbone of the business. And typically, like is mentioned up here, you may be asking yourself, well, how do I bring someone onto an advisory board level position and not pay them, right? Because I can barely pay myself as the founder. Well, what we do here is advisory shares, right? And so the incentive you give for advisors are, very small, as you can see, right? Percentages of the company in order to incentivize them to be a part of the board and to help you out. Boards are very important, right? They're almost as important as investors, right? In the fact that they're really going to be behind you and help facilitate whatever they can. And many investors really find value in the board in seeing that you've assembled a board that is really going to help you, see this thing succeed, see the company succeed. So, almost secondary to your team in terms of importance, as we talk about people in the larger scope of a business, is the advisory board. So if you have an awesome team, an awesome core team that's, busting their butts every day to make this thing happen, and you have an advisory board that is almost like your personal board of directors as a founder, helping you facilitate introductions, do whatever they can to get you into the right places. That advisory board is crucial. Anything on this?
In terms of the board of directors, does Miami Angel look for a board seat?
No.
After investment?
No. Yeah, and we don't look for a board seat because we're what's known as follow-on investors. So a lead investor, typically a lead investor is one who puts a significant amount of money into the round at the very beginning in terms of investment, and then we usually fill out whatever remains from a particular investment round.
And two questions in regards to that. Now, from what you've seen, besides what's written there, what are some possible detractions from the makeup of the board of directors? For instance, is it a big deal if there's 4 founders and all 4 are members of the board, and then the lead investor takes 1 seat?
Yeah. So when I say board and advisors, I mean people except the core team. Like I mean people. Let's say I'm a founder, and Steve, Juan Carlos, these 2 are my advisory members. These are people who aren't at a formal board capacity. They're just people who help me run the business. And so like when I say a board and advisors slide, I'm referring just to the advisory members and not a formal board. Because your formal board is going to be like when you do filings, it's going to be like you and your accountant. It's not going to be like Steve, who's helping me with sales, or Juan Carlos, who's helping me with customer acquisition. Does that distinction make sense?
Yeah,
okay.
I knew the distinction. I was specifically talking about board of directors, and if you incorporate, you have a C corp, and 4 people decide, the core members, that I'm on the board of directors.
Yeah, I find that structure is rarely used, and this slide's just for advisors. Okay. Like I've never seen a slide with boards of directors.
Okay, and that follow-up question. In terms, you said that you do follow along and you're not the lead.
Yeah.
And so going back to the very beginning of how Miami Angels work, so do you go out and find a lead? Because you're talking about, okay, it could be cold emails or whatnot. How does that work?
Sometimes I can help find companies' leads, but those are ones that I find really strong potential in from the very beginning. And others, I'll just say, hey, you're not the right fit for us at this time, but if you get a lead investor and you show some additional traction, we'd love to re-engage in the conversation. And I mean that wholeheartedly. Now, in terms of how does a company go about knowing that, it all goes back to researching who it is that you're sending your pitch deck to, right? Like, there's often emails of people saying, hey, I need $500,000 for my investment round, please invest in me. And if the person had researched us as a group, and not only us as a group, but any other investor that they're reaching out to, they could very clearly see what investment group fits what particular position in the round. So there's some groups that only lead. There's some groups like us who only follow on. And then there's some who do both. But the only way you'll know that is by researching ahead of time to understand what is the thesis of that group. Exit strategy. I'm torn on this, to be honest. It goes back in line with financial projections, right? If there's anything I know about an exit strategy, it's likely that it's wrong because it's very hard to predict. Like I said, you can barely even know what's happening tomorrow in your business's life cycle, let alone how you're going to exit. So this is one that I include here just so that you know that there are some investors who look at that and they'll plainly ask you, how do you think you'll exit? And for some, I'm not saying it's right or wrong, but for some they'll say, I'll only invest if I'm really convinced about how you'll exit. And so all you need to know about this slide in particular is that some are looking at it and some are looking for it. And so as you do your research and as you develop your list of investors to reach out to, understand how important this is to them.
Is that an exit to that specific investor? So if he's a seed investor, you're looking to tell him how he's going to exit, or are you looking at a total exit?
Great question. So I'd say like 95% of the time it's about larger exit, but there are some who will say, how am I going to make money? And those individual investors, usually at the earlier stages, probably aren't in it for the big home run, but they're in it for the 2x or 3x return on their investment. So yeah, just something to think about. I'm less concerned about an exit strategy.
So how does that work when investor decides, okay, I want to go ahead and get my exit now? Like, I guess how does that just work? Like, from a standpoint, like, are they able to just pull cash out of the business, or how does that work in terms of them wanting to make their exit and our responsibility on our end?
Yeah. So it all goes back to how you structure legally the term sheet. But very rarely should you give investors, and this is me as an investor saying this, very rarely should you give investors the ability to pull out money whenever they want, because that's just going to be very disruptive. So that's one where I don't think it's really our place to, as investors, to force the founder's hand and get that money out. But that's really the onus on the founder. That's the founder's challenge to make sure that they're protected in scenarios like that.
Is that why you want to make sure somebody's an accredited investor?
Exactly.
It sounds like they need to be financially stable enough to be able to what they did, right?
Exactly. And so there's a variety of laws in this country that only permit certain people to invest legally into early startup companies. And so you're going to want to seek out those individuals who are usually high net worth individuals to make sure that the people that you're bringing on board, in 1 month aren't in the next month going to say, I missed my paycheck, give me my money back. Because that unfortunately does happen, and unfortunately it's very disruptive to the business and sometimes kills the business. So, again, what the term you mentioned is really important, accredited investors. Like I said at the very beginning, our group, as Miami Angels, is a group of 120 accredited investors, all of which meet different criteria to basically consider themselves as accredited investors and invest. Awesome question. Well, Carlos, this is going to your question on capital raise and use of proceeds. At the very least, after an investor reads a pitch deck, they're going to want to know where their money's going to. And not only where their money's going to, but how does that fit in the overall financial health of the business over time, right? So, you're going to want to know, for example, well, I'm going to want to know as an investor, for example, okay, the $1 million that I give to the gentleman right here in the front, it's going to go to, 20% is going to go to marketing, 30% is going to go to people, 50% is going to go to product development, right? So very clearly laying out in as much detail as you can, obviously knowing that things are going to come up and it's likely going to change, but to the level of granularity that you can, show the investor where that money's going to and how that will enable your business to grow at the speed and at the rate that you're saying it's going to grow at. Did that answer your question? Okay.
But let me elaborate a little bit more to try to understand the right balance into the development phase. And it should be presented here as a thoughtful strategy.
Yeah.
That's my point. Because sometimes when you see certain presentation, then you share allocation of X amount of money.
Mm-hmm.
But then when you go a little bit deeper and say, okay, then how are you going to be using that in X area? Then at the moment, the father is not clear about what kind of team is needed there, or what kind of calculations behind that, or if the team is going to be together, or if it's going to be developers outside of the country, or India, or another place, in order to reduce maybe costs here. So what is the right balance in terms of the level of detail and thoughtful presentation?
Great, yeah, absolutely. So to your point, there's a balance. Like you obviously can't use the entire slide to say, you know, with product development, I'm going to hire 3 people in India to develop the product at X amount per hour, you know, and it's hard to go deeper than that. So what you do is, especially when it involves headcount and really large spend items, since they are accounting for a majority of what's being put in the business, go a layer deeper on those line items, right? Go explain a little more about where the money's going, and not just say headcount. Say, right, because businesses, right, one of the largest line items for business is people and development, which is more often than not people. So going a level deeper in understanding for those really high percentage items that are part of the $1 million, to keep the math simple. If 600 to 700 or any appreciable amount is going into a single bucket of expense, give it the thoughtfulness that it deserves and explain a bit more. Now, what you shouldn't do is, like I was saying earlier, explain an hourly rate, explain many levels down, because where that conversation really starts to happen is in due diligence, right? That's where you really go below the hood and understand exactly where all that money's going, down to very, very granular detail. Okay. Do you have a question?
No.
Okay. Sorry. Awesome. So closing slide. I can't tell you how many times I am looking to call an entrepreneur because I had a random thought, or we were following up on a conversation we had, and I'm trying to find their information. Not just in a closing slide should you have that, but on every email, have a signature line with your email, cell phone, whatever means of communication. It's as basic as it sounds. You'd be surprised how often I get that. So just make it very easy for a founder or an investor to contact you. And so for the purpose of the presentation or the pitch deck, make sure it's at the last slide, and then just for everything else, have it almost tattooed on you if you can. Actually, don't do that. but you guys know what I mean. So there's a bunch of questions here. Again, you'll get the deck, and through the conversation that we've been having, we've actually hit on a lot of these. So I won't touch through these, but it's quite a lot. And then this recap, I'll just zoom through entirely. Well, actually, I'm not going to touch it. What I'd rather do is use this time to, again, you'll get all this. Use this time to actually ask from the audience. Before I do that, I think a big question that we all have is, okay, so I know how to make a pitch deck. Daniel has given us some decent advice about how to go about this thing that we call fundraising. But now, where do I start now, right? After I have this really awesome pitch deck that looks great, that communicates the message, who do I put this to, right? And so we'll just speak to Florida as an example, right? There's us, and then there's a variety of other VCs and angel network collectives. But what I don't want you to do is find the emails for all these folks and say, hey, here's my pitch, invest in me, right? Because that would totally destroy what we've all talked about today, which is being thoughtful about who you reach out to and the investor that you're trying to sell your idea to and get them to invest in. So, right, I can tell you right off the bat that in these funds, there's no one who's going to invest in an idea. And so what would really suck is if your business right now happens to be at the idea stage and you send it to these folks. Because I can guarantee you, on their end, they have some tracker that's going to where they're going to say, okay, I received this deck at the idea stage, and because they send it to me at the idea stage, I'm just not going to entertain it anymore because I have 100 other companies that I have to review. So again, it gets down to the real important aspect of pitching to understand your audience and understand the investors that you're pitching to. But for the sake of understanding what the landscape is like, because we all like to, I'd really love to see everyone's business, especially those that are at the idea stage, to realize themselves and become products that are viable and are actually selling in the market. And when they do become viable products and viable companies, these are the people that you're going to want to see, who are on this slide. So just something to think about. Yeah.
Not only tech.
Yeah, not only tech. Yeah. There's some folks who don't just invest in tech. Yeah. 500 startups, for example, who's not on this slide, but a recent global capital firm. They invest in tech-enabled, which is it's loosely defined as just anything that interacts with the physical world. Any tech that interacts with the physical world. So they have a broad scope. And then you have some that may not invest in tech. And to your point there, it all goes back to researching who it is that you're selling it to. Yeah.
So doing the research is obviously very important. And
yeah.
How open are these companies to telling you, like, the investor, like, hey, this is what I'm looking for?
Great question. You mean how open are investor groups to just receiving decks?
No. To telling the founder what they're looking for.
Oh, okay. So just
answer the first question too. Both of those questions are good.
Yeah. So and they're both intertwined because you have some venture capital firms who don't even have email addresses and they only work on referrals. And those are really hard ones to break into. I'm not going to lie. But us as a group, I respond to every single email. Even though it may not be our fit, I'll tell you why. I'll look at your deck and I'll say, hey, for X and Y reason, you're just not a fit for us right now. Keep us posted on your traction. But there are many, and I'm not going to sugarcoat this, but there are many venture capitalists who you'll send it to, and you only get a response.
Following up on that, you received a pitch, gave them feedback, and then returned the pitch again and evaluated it more seriously?
Yeah, but that usually takes some time. Yeah, and I can tell you the dirty little secret behind our group. We have a CRM that plugs into our email, where literally every single deck that I get gets filed and cataloged, and I know when you send me that deck, I have a copy of that deck, and I know the next time you send me another deck, the difference, and how you've grown over time. So. And every venture capital group is going to work the same way. But where we start to differ is how we approach inbound pitches and pitch decks. I personally don't subscribe to not giving a response back. You'll always get a response from them. It may take some time, but you'll always get a response from them. Yeah, and actually to that point, if we think about this being a process. And if you're able to find those investors who are able to give you that feedback, I would almost target them first, because then it's almost like a dry run for those venture capital firms where you really only get one shot. And even before you send it to those venture capital firms that will actually give you feedback, Ask your network, ask your core team, ask your board of advisors, right? Ask people who are close to you to run through the deck, make sure it's up to par, and then go up the chain like I was saying. Was there another hand up? Yeah.
Yeah, that was mine. Yeah, kind of going through this where let's just say like, hey, I got my deck, it's all ready today. I mean, I love sales and I love the whole process of it, but I know like even pitching your own ideas, being through it, it's really helpful to actually have, conversations with people live and see how they're actually taking it. So these would be the ones who are somewhat ideal in the area. Is there like a list of, like, let's just say this is an A group, I don't know if it is or not, but let's just say it's an A group. Is there like a series like B or C group you can go to and like really like practice this bit so eventually you want to work with, you're polished, you're good, you get that great first impression?
In Florida or
just in general, just thinking like in general, where are some places we can go to kind of look for that?
VC is an unnecessarily mystic industry, and there's no like silver bullet. So a lot of it's going to be self-sourced. I can tell you if you manage to have a connection within a VC firm, like an associated or anyone who looks at a lot of decks, or even someone who looks at a lot of decks in another professional service capacity, like they're going to get it.
So then it might make sense to maybe even just like think of like, oh, who gets stuff like this? Maybe
Exactly.
Talking like if I have a bank account and talk to a commercial banker that talks to people and they have to put this stuff and go together and people like that to run through it.
Yeah.
Okay.
Yeah.
Got it. Just figure out how you're getting there.
Exactly. Just figure out how you're getting in and use a bunch of opinions to ultimately boil down to what you feel good about presenting.
Mm-hmm.
But also just know that with VC being a very incestuous industry, there is going to be a certain form factor. So just blending what you want to have as your narrative with how it's typically displayed, with obviously nuances to your style and things like that, is the best approach.
So it's almost just like you're just being very open and vulnerable when you are talking to people as you're going on, letting them know where you're at. Because obviously you want to go to a VC if you're just doing so well, you didn't even cash, but it's more important instead of acting like you know what you're doing.
Exactly.
Where I'm at, here's where I'm going.
Exactly.
Okay.
And that's what I personally subscribe to, not just in pitching, but just generally. If you're a more transparent individual, that's going to go such a long way. And if you're able to be not only transparent but coachable, if you're able to get the sometimes harsh feedback from a VC and really internalize it and use it to better your presentation, then it's going to go a long way. Because those are insights where if you weren't that coachable person, you just say, that guy doesn't know what the hell he's talking about. He has a $100 million fund, but he just really doesn't know what he's talking about. And so I'm not going to use whatever he said, right? So being coachable and at the same time transparent is going to, like, seriously, guys and gals, pay so many dividends going forward. So that's not the end, it's just the last slide. But I'll set up your,
based on that, so I tried to work with a group called Marquee. You basically give them the deck, and they have like they're Indian, and they basically scrape the list of every VC in the country, and they're sending it out to like 50 a week in pledges. It didn't work for us, but I think also because we were really early then. That was like 18 months ago. What do you think about that kind of? I mean, from what it sounds like, you would advise against that.
Correct. Exactly. I would you can't think of investment as a silver bullet. It's going to take that personal touch. It's going to take thoughtfulness. And again, it'll take a lot of time at the front end, but it's going to convert much faster than blasting into 50 people. Yeah, I can tell you in the 8 months that I've been in this role, there hasn't been a single company that has just been blasted to me that I've invested in. So if that helps, really has to be a thoughtful approach. And then there was one over here, and then yeah.
Should you look for local VCs or in our case, we're in 2 markets and out there? Is it even worth talking to VCs here, or should I be looking at VCs out
Well, you can answer that from the investor perspective, and you can answer that from your perspective. Investors sometimes don't invest outside of a particular region. Like we won't invest in a company if there's no association to Florida. So that's an example. And then there's many others. There are many others that won't invest outside of the U.S. or outside of a particular region, or even outside of their city. Right? It just all depends on the particular thesis of that group. And then from your perspective, you're going to want money that's going to further your interest as a founder and as a company. So, for example, and I'll use this very obvious example, not to belittle the point that you made, because it's a very good one, but to just explain how when you break it down very fundamentally, it makes the point very clear. So, like, for example, let's say I'm a founder making the newest and best smart AC system. I'm probably not going to find my investor for the newest, best smart AC system in Antarctica, assuming that there's like a VC firm out there, right? You're gonna and there's a variety of reasons why, right? Because one, you don't need an AC in Antarctica, so that VC isn't going to help me for anything, right? So from your perspective, it's very, like, again, all going back to thoughtfulness. Why is that investor going to give me the smart capital that I need, right? But really two great questions. And you have one?
Yeah, so when you're thinking about pitching to an investor, if you're beyond the idea stage where you have a prototype, but you're before the stage where you have a customer, is it worth it to wait until you have a customer to show, like, hey, there is a demand for this thing that I'm doing? Or is it worth, bringing your idea to the investors, maybe bring it, like, to the markets that you didn't even know that you were, like, looking at, or something like that?
We had a similar conversation earlier on, and it basically comes down to the specific investor that you're targeting. Some, for example, within our own group, love early deals, and they love early deals for a variety of reasons. They love early deals because they feel like they can add value, assuming it's needed. They feel like they can get a better deal, which in founder speak means they'll be able to own more of your company. And so there's a variety of personal, professional, and economical reasons why some investors like early. But what I'll say to you for your particular scenario is just one, make sure you evaluate all options to you. In other words, do I need to invest now at the stage that my company's in, or can I afford to wait, scrape up all the money that I have in order to get my product launched, and then at that point, now that the product is launched and gaining traction, be able to seek investment. And now, why that decision, right? Why now versus later? Well, I was having a conversation with this gentleman earlier about what we call a value inflection point. And what that it may sound fancy, but what that really just means is you choose to go out to seek investment at different stages of your company's life cycle. It's going to be much easier and much less expensive for you as a founder if you're able to have proof that your product has product market fit, that it already has traction, that it's already making money, right? And so choosing to pitch your company at X early stage versus choosing to pitch your company at Y later stage is by and large an easier case to present, and it's also usually very much less expensive for the founder. In other words, you're giving less of your company. I have like three. Let me go you, and then Steve, and then okay.
Okay, thank you, because my question goes perfectly with what you're saying. In our particular case, we are kind of stuck exactly where you were saying, where we've been at it for 10 years. We did it organically. We did a software. We have 15 customers. Everything is good, but then now we went for growth because the company we compete with just raised $22 million.
Wow.
And they're doing great.
Yeah.
And I was like, we're in telecommunications, so it's a big market. So then you say, how are you going to compete with that?
Mm-hmm.
And We haven't done it formally, but through networks, we've been introduced to like venture capital, and all of a sudden it's like, well, we only talk to people that need $5 to $10 million. So now we're kind of stuck where we are a little bit too big for like certain companies, but too small for the majority of the companies we're in interaction with. What would be your advice?
There's always going to be a VC that's going to fill the void where you're in. There's always companies that fit within certain theses of I don't even know if that's a word. There's certain investment thesis of particular groups. Again, the real challenge is just seeking those out. Yeah, but for example, we have companies coming to us all the time telling us, hey, we're raising a $250,000 round. We have a lead who put $150,000 in, and there's 100 left. Will you invest? And we'll simply tell them no, because we invest higher than that. And then there are other companies that say, we're raising $5 million, and we have half of that already committed and invested in. Will you take the next $2.5 million? And we just say we can't, because we slot in under that. So just the same way where exactly, it's just difficult.
It's like dating, it's really
yeah.
until you find the right.
Exactly, until you find the right target, it doesn't work. And what makes at least ours in particular really difficult is not only are we looking for the right stage, but we also need a lead to be in the round. So and usually what happens after a lead's in the round, everyone who's been like, I'll wait until you have some money in. Usually everyone who they've talked to up until that point when they get a lead, everyone just jumps in. And so we're literally like, we have to get everyone back and then make sure that we have a position. So just the same way that you're having the issue of finding the investor, the investors are having the challenge of finding companies that fit within their thesis. So, great question. Yeah, there was another one. Yeah, perfect.
Yeah, it kind of goes into this too. In terms of like thinking about like, if I want to present my valuation a little bit, I'm like thinking like, hey, like, the B or C round, like, I don't want to dilute myself like too much. If I'm thinking about myself now, like in the BC angel round, would it make more sense? Would I be able to get a bigger valuation if not only as the founder I've gotten some traction, but then I can also forecast what my revenues are going to be over, let's say like 2 quarters or a year, and I can say, hey, based off of these numbers, I'm not just me, the CEO or me, the co-founder, but I also have 2 or 3 salespeople, and here's their numbers, here's what we can know. We'd be able to get more valuation out of that type of thing versus like, sometimes I run into people and it's like, I'll work with the owner, they built this $10 million business, and then you start looking at it and you're like, well, you got everything from referrals in your network, and you hire a sales guy that you have to fire because he's going to get anywhere, but you don't have a process or grow traction, so how are you going to grow? So like, is that something that investors look at or think about?
Yeah, absolutely. So in general, and it goes back to a very fundamental principle. If you have something that actually exists, it'll always be worth more than something that doesn't exist. And so it goes back to this value inflection point, right? When do you choose to invest? When do you choose to put yourself out there to get invested in and begin to pitch your company? Obviously, people do this, like the Ubers of the world. They've done this, I think they're at their Series G. They've done this 12 times, right? They've pitched many, many times over and gotten many, many billions of dollars invested into them as a company. But they're very calculated when they choose to invest, when they choose to pitch and seek investment from investors. And the reason why it's so calculated is because there are certain milestones, which I think is what you're getting to, that a business reaches, whether it's traction, whether it's a sales force, whether it's revenues, whether it's a commercially viable product. There are certain milestones that are so important enough, that are important enough to when they're actually realized, it just changes the value of the company. And so the challenge for the entrepreneur, a conversation that you and I were having during the break, was when is that right time? And frankly, no one knows that but the founder. And that's because they know how much money's left in the bank. They know, and that's a good laugh, because that's every founder's problem, right? How much money do I have to live? And so there are real issues like that where you can't wait for a milestone for a business to happen, right? You just have to invest, but you have to know. Sorry, you just have to pitch. You just have to know that whenever it is that you do go out there to pitch and receive investment, that it makes sense, and that it's what you need to do. It goes back to one of the earlier slides. Only raise when you need to raise, right? But great question. Yes?
I've got a couple of questions. Does it make sense to reach out to potential investors, bearing in mind the sort of 4 to 5 month potential window that you're talking about, to have that straddle a milestone, in the sense that you go out, let's say, a month or 2 months before, you know you're going to fund it through whatever existing means up until, let's say, the launch of the product, but you want for people to be aware of the fact that you're in that process, to then look to actually get to terms after the milestone, which is obviously beneficial to you. Is there value, or is there not enough time in the day for that really to happen?
There's the time in the day that you want there to be time in the day. And so if every investor thought the way you think about approaching the investor-founder relationship, if every founder thought that way, then my job would be a hell of a lot easier, because I wouldn't have to tell people that it's just not the right fit. So if you can have the foresight to plan and identify investors well before you need to raise, and formally launch a raise. If you're able to say, hey Dan, I heard your talk, here's my deck, don't want you to invest, but just look at it, right? I'll be reaching back out in 6 months when I'm making $100,000 in monthly revenue, I'll talk to you then, right? Basically telling me, okay, this we're starting the relationship at that point, right? Point zero, where I now know who you are. It may not be the business that I get re-engaged with at the time you reach out to me again, but I'm able to see over time how you've progressed. And that's so important, because if you reach out to me when you've launched a raise and when you're like, oh my God, I have $1,000 in my bank account, I need money now, more often than not, there won't be a fit. And it's for a variety of reasons, but if you approach this almost like dating, like you had said, and if you realize that this is going to build up to a point where an investment comes out of it, then you'll approach this with some time, with some distance.
So
great question.
My second question was, you said you're a follow-on investor.
Yeah.
Is that at all stages?
Yeah. So we only invest at the seed stage, which is for those of you who hear stage and may not understand what that means. So friends and family round is the first round that you raise. Seed is directly after that. So typically what we see for seed is a product that's at the MVP stage, or a prototype, using another term. And then after that, which is what we call pre-Series A. And that's a bit nuanced, but that's basically before a company really starts to take off.
And what's the rationale for being solely a follow-on investor and not a lead?
Great question. So with 120 angel investor members, it's very hard to get 120 angel investor members to agree on terms at a lead position as a lead investor, because lead investors, when they invest, they'll set terms. People will have all different opinions on different clauses and how much we should invest and at what valuation. So we skip that altogether, and we will invest as a follow-on, because by the time a company is looking for follow-on investment after they have a lead investor committed, all those things are already set, and it becomes a non-starter. And so we're able to invest on what we're given, and so it becomes a very binary decision then. And also the other aspect of that is that it just, given that we're organizing so many people around investing in one company, just having to do that exercise of negotiating would just we wouldn't be able to invest, because it would take months, like years, you know, so that's why we do that. Great question. You and then, yeah, perfect. I'll just go down the line.
Question about product market fit. What's your operational definition? Because I think you talk to 10 different people, you get 10 different definitions, and one advisor told me is when you have revenue of 5 million. Is yours where that 25K, 75K you're looking at, is that synonymous with product market fit for you?
No, it's I'll be your 11th definition. You know, there is no, it's arbitrary, right? It's hard to peg it at something. But if we're going to generalize, I'd say product market fit is when you, as a founder, are able to say, okay, I'm going to quit my job because there's something here. So if that passes your sniff test, then I think you have product market fit. For Mark Zuckerberg, right, it was like, I'm going to drop out of Harvard because I know there's something here, right? And I need to commit my time to seeing this thing succeed. So that'll be your 11th definition. I hope it helps. But truly, a lot of this stuff is really arbitrary and just not peggable. But I think it's a good way to think about it. Yeah. If you're ready to quit, then you know something's there most likely.
Thank you.
Yeah. Great question. You and then you.
So you mentioned that your follow-on fund that's locally focused, regionally focused. Do you find that most of the investments you guys do make are with lead investors from this area, or is it just anywhere like SFVC fund that you kind of jump to?
Great question. Did everyone hear that? So the question was, given that we're a follow-on investor, do we just invest with leads in Florida or Miami or whatever geographic region you want to define, or do we go outside of the state and into places like San Francisco or New York? So we've done both, and we don't necessarily only follow on to particular investors. Obviously, what helps is when you have a lead investor of some sort of prominence and prestige, and that they know what they're doing. If we have leads like those, it becomes very helpful, and very helpful for us to invest, because it validates the business even more. For one thing, we know that a very prestigious premier firm would not invest in them if there wasn't something there. That's the really practical reason. The other reason is because they've a lot of times done the work to vet that company, and that's something that they'll share with us. So it helps to get a second opinion on a company that they invested in. So those are the two reasons why we follow on and why we're not necessarily strict on where who we follow on with. Now, I'll give you an example of actually a company that we did introduce to their lead investor here in Florida that actually panned out to be a really great investment. And it's a company called Baby Sparks. It's a mobile app that helps with motor skill and cognitive development in babies up until the age of 2, from the time they're born. And that's a scenario where we introduced them to the lead investor, because from the minute I saw him and heard his pitch, I was immediately thrilled. I told him if we led, I would lead right now. So it's those companies that just blow my mind. It was entirely bootstrapped. Just him, his team, his product was just exceptional. And it was like my mining for gold. Like that was like my nugget, and that was the first one I've seen in the 8 months that I've been here. And so we introduced him to his lead, the lead invested, and then we came in and followed on. So that's an example of, and that lead happened to have been in Florida. But that's just because we knew that this would be an investor of value for them and would help them along their journey, as would we. Great question. Yes?
So kind of piggybacking off of that question, in my particular case, I'm graduating soon,
Okay.
and I'm going to be moving, but my business has a market in Florida, So I plan to like I haven't worked out all the details yet, but I just want to have that information. But I plan to have my business operate in Florida, and then if it grows, it grows. But because I'm moving, does it make sense to try to find an investor in this area, or maybe the area that I'll be in, or like?
Good question. So the question for those who didn't hear was, this gentleman, he's graduating soon. He plans to keep his business running from where he moves, and he's deciding whether to get an investor at the site that he moves to, or here in Florida where the company's based. Honestly, that's a tough one because there's a lot of nuance that I don't know about. But it's all I would say is as you approach investors here in Florida and also wherever it is that you're moving, just be very transparent. Again, my buzzword for the day about your intention, because I find that investors really want you to commit to the business, and if you're running it remotely, it gets tough. It gets tough. I don't know if there's an option where you can bring your company with you and the team that you've built. Again, assuming you're at that stage. But more often than not, investors are going to want you to be very, very close to your product. Very, very close to your product. Great question. Yeah.
Going back to the Baby Sparks example.
Could you project?
Oh yeah. So going back to the example you were just talking about, where you referred to a lead investor. What was it about that lead that suggested they would definitely be of value? And maybe generally speaking, what designates certain firms as definitely smart capital as opposed to just passive investment?
Yeah. Did everyone hear that? Okay. So why we identified that particular VC as the lead? We knew them. Like I said, VC is a very mystical and incestuous industry, for better, for worse, more times for worse. But we just knew who they were, the caliber of people they were, what they invested in before. So we knew this was a great business to recommend them to. And we knew that if we recommended to them, they would see the value in the business as well. And they did, and they invested. And the second question was why them, or?
No, just what designates certain firms as smart capital?
Yes. So that's an excellent question. And it goes back to how much time are they willing to give to you as a founder for what you need. That's what it boils down to. And the smart capital is very important for that specific reason. Because if they're just going to give you money and let you run, and when you're calling them, they're just like, hey, I'm on a private island, talk to me in 3 months when I'm back, that's not really helpful. So knowing in those types of situations how they'll react is what's going to clearly divide for you who is smart capital from non-smart capital. But again, there's no silver bullet, to know who these people are. It again goes back to relationship. It goes back to feeling them out. It goes back to even posing these scenarios like on a hypothetical basis, right? And if he tells you something or she tells you something that is alarming, then it's probably going to pan out that way. So again, don't just run into it because they're waving some money in the air. Really go into it knowing that sure they have money in the air, but when it comes down to it, they're going to help you out. Yes.
I know transparency is the word of the day.
Yeah.
But,
along with a few others.
When you're dealing with proprietary technology or information, how cautious do you recommend being when you're pitching to someone that you're not familiar with?
Very good question. Because it's one I get a lot. I'll tell you right now, I won't sign an NDA because I see in the 8 months that I've been here, I've seen close to like 600-700 companies, and it opens me up to unnecessary liability, and it opens up any other investor to necessary liability. It's not to say don't be cautious when you put forward an investment to an investor, but it is saying it is what I mean to say with that is exercise discretion with what you put on your pitch deck. Like, don't put the login credentials to your code base on your pitch deck, because that's gonna work out pretty poorly. But at the same time, don't put in big red letters, right? Revenues is confidential, right? So there's that medium that you need to feel comfortable with as a founder. And honestly, the only way you'll be able to develop your sense of transparency is first finding a person who knows the space, who is relatively trustworthy, and just asking them, hey, what do you think about this? I'm actually having a conversation with a gentleman who is basically, he's had his startup for the last year or so in stealth mode. Like, he hasn't made it public. He's just been heads down working on his product. He came to one of my office hours that I hold around the city. He went into that meeting saying, hey, I have an idea that I'm working on. It's this old, it's in this segment. And me knowing that this person at the onset was relatively quiet about what he was building, I respected that. But what he told me after the fact, after we got to know each other really well, was you were the only investor who didn't try to pry and ask, oh, what about this? What about this? Not saying that people who do have necessarily bad intentions, but he respected the fact that I just let him talk and I understood the business. Now, how does that translate to your original question is feel the person out. If the person's asking for things that you find are pretty intrusive and potentially like really confidential, follow your intuition in those instances. But you're definitely going to want to, as you develop your sense for transparency and the narrative that you want to create, know that there are extremes to this, right? And just, again, put yourself in the shoes of the investor, assuming that they're a credible person and not going to leak what you send them. And just make sure that narrative, fits what they need to know. And all I'll say about investors asking for NDAs, founders asking for investors to sign NDAs, is I just wouldn't do that because you're no one. I don't think an investor who sees a considerable amount of deals is going to sign an NDA. But an individual who happens to be an accredited investor may do that. But like I said, anyone who's seeing an appreciable amount of deals just won't.
It would also work against the VC if they actually steal the idea.
Oh, exactly. Yeah, that's what I'm saying. Like I'm in no position to sign an NDA because any investor, any founder who I sign an NDA with is going to say, as soon as his idea gets copied, he's going to say, I'm suing you just because you signed an NDA and my idea is out, with no real basis as to who actually did that or why there's another company out there. So, to your point.
And in the event if they do steal the idea,
then
there's
right. Yeah.
Like no one's gonna.
Your reputation as a VC.
Yeah,
you're
exactly.
do another deal.
Exactly. So there's a variety of reasons, but first get comfortable with who you're sending it to, and just make sure that what's on the deck, what's on the pitch deck, is what they need to formulate an opinion.